you went through and you classified rallies. And this is one of the hardest things to do because it's what what qualifies as success, what qualifies as failure. So when someone asks, what is a follow through day and how often does it work? You actually went and said, okay, well, based on what IBD has called a follow through day and the start of a rally, let's look at it. And why don't you share real quickly or remind folks that have seen this before what you came up with in terms of your classifications?
Well, I went back originally to the beginning of the paper and had all the data on follow through days and also from many of the IBD seminars. You had posted, there were a lot of books given out and there were more dates in there. And I went all the way back to 1942 using some of my own research to find out what would be classified as follow through days and how could we classify them in terms of what would be successful or not. And based on some conversations I've had with you and others, we came up with some of things like this. We decided to call rallies into four categories. The whipsaws were ones that lasted 15 days or less. It didn't matter whether the market finished up or down after the follow through day. If it was 15 days or less, it was a whipsaw. And if it was something that lasted more than 15 days, but the market index gained less than 3% from the beginning, from the close of the follow through day until the end of the rally, it was a small loss or gains, or we call them slogs.
Mhm.
If it was something that lasted more than 15 days, but the market gained in the index from 3% up to 15%, we called those money makers. Now, remember, these are the index changes. Individual stocks can change a lot more than that during that
Yes.
rally. So it may sound like a small amount to gain between 3 and 15%, but an individual leading stock, that might gain anywhere from 20, 30 to 40% in that kind of a time frame.
Or
And a
more.
life changer
Absolutely.
rally, and a life changer rally was one that was more than 15 days and more than 15%. So that's kind of like the 15-15 rule. It had to be longer than 15 days and gain more than 15% from the index viewpoint. And that's where you made some really big gains in individual stocks. Sometimes those gains can be 20, 30, 50, 100 to 200% during life changer rallies.
Mhm. And s and so when you're measuring this, you said from the follow-through day to the end of the rally. What qualifies as the end of the rally? Because I can always tell where a top is if you just let me go a few months, afterwards. But, so how were you doing this for your research?
My original study was based on when did the Investors Business Daily say market in correction. Sometimes they would say under pressure, but as far as I was concerned, the rally was still going. It was
Yeah.
when IBD either said in the newspaper or when they said online in the market pulse. If they said market in correction, that's when I said the rally's over.
Mhm. And then when you say gain, were you measuring from the follow-through day to the gain at the time that it went to correction or where it went to, at the peak?
Those numbers were at the time the market went into correction, so the last day of the rally. The
Mhm.
numbers for peaks were a little bit higher. On average, it's about 5% higher than what that happens at the end day close. But I would measure those for when you guys said the market's in correction, that close on that day.
Yeah, and that kind of lets you know that, you had enough time to get out of the market. Because I mean,
Yes.
if you have a crash, then it's a little bit tougher to call that a life changer if, you didn't get a chance to get out and it just,
Yeah.
crashed on you.
Yeah, the
Um,
wrong kind of a life changer.
yes,
Yeah.
exactly, right. The regret, the regretful change.
Yeah.
So now that we have those definitions, again, one of the greatest things is that you kind of said, okay, well, how often do these happen? And so if you could just share this slide real quick for folks.
Well, let's just summarize it quickly this one way. It's about a one-third green, two-thirds red
Yeah.
scenario, which means about a third of the time, the follow-through days produce rallies where you could make money and do really well. And two-thirds of the time, you either didn't make money or very little with a small loss or gains, or you lost money with a whipsaw. And
Mhm.
so if people want to think of it that way, follow through days produce rallies where you can make money about a third of the time.
Yeah. And I just want to stress again, because it's one thing to be looking at the indexes as your guide, but individual stocks are kind of where you're making your money. And this is where the risk management comes in place. Last week we had Mark Ritchie II on from Minervini Private Access, and you know he was very honest about you can be right 33% of the time and make a fortune as long as you're making those decisions that when you're not making money, you cut your losses quickly. So don't be disheartened if you look at this pie graph and you're like, what, a third of the time? That's it? As long as you're cutting your losses when you're not wrong, when you're not right, when things aren't going your way, you can really supercharge things when you are right. Losing a little to gain a lot. And let's just put today's rally in context. So you actually provided this almost at the close, but very late in the day, intraday, in terms of where we are here on September 10th, 2025 versus the average. So we've got the red is the current rally starting from April 22nd follow through day, and then you've got the averages of all these different ones. So talk to me a little bit about how different this rally is, or is it just kind of like in its own little special 1% kind of thing?
Well, the way I use this chart is in such a way that when a follow through day happens, I start plotting the top red line, and I want to know, where does this rally compare to the past? And if it's above the green life changer line, you start to get excited, and I start to get a little bit more aggressive in how I invest. If instead that line starts to go below life changer and is near money makers, I'll probably still be aggressive and maybe not as aggressive. Or if I see it running along the slog line, and especially if I see it near the whipsaw line, I'm not going to be so aggressive. I might even lighten up. And the whole idea is we'd like to know when a follow through day happens, what kind of rally is this going to be? And if I start charting it versus the historical lines there, you get a pretty good idea right away. And this chart shows the first 25 days of a rally after a follow through day. And you can see the whipsaws, well, they end in 15 days or less, right? So that line's going to stop at 15 days. But you can see those other lines. And how did this rally stack up? Well, I knew pretty early, within the first 5 days or so, we were way above the top line of a life changer average. And so I thought to myself, this looks like a good rally. So I started to get more aggressive with my investing. And that's how I tell your listeners, if you can do something like this and just start plotting it, you can take a screenshot of this and start plotting, how's the rally going? You'll know, how is this rally shaping up?
And do you find that there's any clues? Because we're going to be talking about the pullbacks and the corrections, but do you find that there's any clues in terms of the correction? There's often that kind of feeling that the harder you come in, the better the bounce a lot of times. And that was certainly the case with COVID. We came in very fast, very hard, and when we did get the April 2nd follow-through day on the S&P 500, April 6th follow-through day in 2020 on the NASDAQ, it was a really, really powerful rally, probably on a similar trajectory above the average as this one is. So do you ever look at, this correction is such that I would expect maybe an even better than average life-changing type rally?
Sometimes you can have that expectation, but in general, I have found it's really good to just compare it against not only this graph, but also some historical ones. For example, we had one last August, if I recall. We started out pretty sharp above the life changer line, and then slowly but surely it kept decaying. The index wasn't going up as fast, and it started to come down to the moneymaker line. It went below the moneymaker line for a while. And so it was one of those things where we started off high and we looked like we had a sharp bounce up, but then it started to fade. And so that's one way to look at it too, is like you can expect that it might be coming up fast, like a post-COVID or a post-tariff Liberation Day bounce. But you really need to just keep watching it and compare to history and know that it doesn't always have to be that way.
Yeah, so almost trust but verify, I guess. You can have your
Exactly right.
thesis, but wait for the data before you do
Yeah.
too much. And yeah, that totally makes sense. And then kind of moving on here, also in terms of length of time, Where are we at right now?
And this graph shows, especially the blue line there, that shows you how long rallies typically last. And if you look at the right side scale, you can see that rising up toward 100%. And along the bottom are the number of days. We are 97 trading days into this rally. And by now, almost, I think it's like 85 to maybe 90% of most rallies don't last this long. So this one is pretty long in the tooth, but I've also marked two dates on there. The average age of a moneymaker rally is 66 days, and the average life changer rally goes 140 days. Well, we're 97 days into it, so we're that's another sign we're in a life changer rally, right? But
Hmm.
it also shows that we could go another, um, 43 trading days, which is 2 more months, and that wouldn't be, unexpected. And
Yeah.
I don't use these graphs to make decisions to predict the market. I use these graphs to be aware of where we're at. So, for example, I know there could be 43 days more to go for the average life changer, and it just makes me think to start thinking about if I have a stock with really big gains and the stock starts to pull back, maybe that's a stock that I need to either hedge or maybe lighten up a little bit on the number of shares. I don't use these to predict and then do things preemptively, but I'm always aware that those exist and where we're at.